You got a new fan, Andy.
Totally. Yeah, Keith loves our show. Loves it.
I guess he commented a few times, huh?
So we had Ed Slott, and I guess he doesn't care for us or Ed or all of the above.
I don't think he cares for Roth conversions, and especially took issue with some of the things that Ed said. Yeah.
All right.
Yep.
So he's commenting on some of the content we put out there.
Okay.
So I'll read some of this stuff.
Okay, cool.
All right. So he goes, hey, the reason the government loves Roth is they get their tax up front and can invest that instead of you investing in it. Hello? Who's short-sighted? I guess I am. In case there is any question with the math, you are 60 today. You could burn $100,000 today in the 24% tax bracket and send the IRS $24,000. If you defer for 15 years, even if you hit the bottom of the 28% tax bracket, your effective rate will be less than 20. That is all that matters. What percentage do you pay to convert versus what percentage tax do you defer? Okay. Anything else is noise by financial advisors to make it seem more complicated than it actually is. Okay.
Okay.
You got to look at effective rate versus marginal rate.
Yeah, completely messed up those two terms. You got to look at marginal versus marginal. Effective rate is completely irrelevant when you're talking Roth conversions.
Do tell.
So does he keep going?
Oh yeah, I'll keep going.
Okay.
All right. I like you. Big Al's getting a little spicy here with Keith. Completely irrelevant, Keith. All right. These videos make me laugh. See, that's what we're here for, Keith, is to make people laugh. This is called entertainment.
Sure.
All right. I give credit for the good job with the catchphrases. I'll throw one out there. More sizzle than substance. Or how about all hat, no cattle? Let's analyze them. Tax time bomb. Very catchy, but not accurate for most. Totally agree. Most people have like $40,000 in a retirement account.
100% agree. Usually people that are listening to our podcast or watching our show have money, and so this makes complete sense for them.
But I totally agree. It does. The average balance of a retirement account is a couple $100,000. If you have a couple $100,000, it probably doesn't make sense to convert. But in some cases it does. Because then if I could convert with a couple $100,000, and let's say I have Social Security and my IRMA and everything else, I could live tax-free for the rest of my life and not pay another dime in tax. Depending on what happens with the standard deduction, there's a lot of different analysis that needs to go in. I think what the point is that you just have to be aware of what you're currently doing. Does it make sense to be diversified from a tax perspective, or does it not? Choice is yours. Okay, what's another little catchphrase he likes?
Okay.
Do your due diligence. Is that a catchphrase?
No, that's him saying do your due diligence regarding the tax time bomb.
Yeah, please, everyone should be doing their due diligence. Okay, let's see. The RMD on $1 million RMD, he repeats himself quite a bit. The RMD on $1 million RMD is minimal from forever taxed to never taxed. Totally bull. It's really from pay tax today at your top marginal rate to defer and pay slowly, taking advantage of inflation adjustments. Okay, whatever. The halftime analogy. It's not even understandable.
Wow. Ed Slott did talk about a football game.
Yeah, halftime. IRA is an IOU to the IRS. How did you come up with that one? I don't know. Let's see. If you are 60 today with an IRA and defer, when RMDs kicked in at age 75, your RMD on $1 million will be less than the standard deduction index for inflation. If you only have RMDs and Social Security, you will pay zero tax. Anyone with less than $1 million in an IRA should run away from this advice, which is meant to sell books and not help you. FYI, I've replied with these true comments before, and they never reply. Truth is tough to swallow. I don't even know how to reply, Keith. So we are replying now.
That's my job, and I will post this for Keith after this is done.
But the point is, most people spend a little bit more. They want to maintain their lifestyle. So if I'm only going to spend my RMD and have a standard deduction and live off Social Security, you're right. I'm probably not going to pay very little in tax. But the point is that people have different assets from different sources, different income from different sources. So you have to take a look at, if you want to talk about effective rates, what's your effective rate today versus your effective rate in the future? What's your marginal rate today versus your marginal rate in the future? If you can control your taxes long-term by being diversified from a tax perspective, you will lower your effective rate in retirement by doing so. But if you want to live off of $30,000 a year, you're right. Guess what? You're not going to pay any tax. You're not, because there's no income.
And Keith, I will say one thing, just because I think you like to run the numbers. Is your example of $1 million IRA, let's call it a $40,000 required minimum distribution plus your Social Security, which could be another 40,000, right? If you're married, then you got 2 Social Securities. But let's just go with that. You're single, you got 70,000 of income. Now all of a sudden, a bunch of your Social Security is taxable that would not have been taxable if you didn't have that RMD. And if you do 2 tax projections with and without the RMD, you're going to see that the effective rate of adding taxability to your Social Security in some cases works out to 27% rate, because here's what happens is you pay the rate for the tax itself, and you also, I mean, for the RMD itself, and you also pay the rate that now more of your Social Security all of a sudden magically becomes taxable. You just have to run the numbers and think about what you're saying. But I do agree, if you have a very small IRA and not that much Social Security, you're not going to pay any tax anyway. So why would you convert? So we're trying to do examples where it does make sense to convert.
I agree with Keith 100% on most of this. If you don't have a lot of money in retirement accounts, if you don't have a lot of fixed income, if you're going to spend a very little dollars in retirement, or depending on, if you spend 50, 60,000, or let's say you have your RMD and Social Security, okay, that's fine. But if someone wants to maintain a lifestyle of 100, 150, 200,000, or whatever the dollars are, and all of that money has to come out from a retirement account, that's all still taxed at ordinary income rates. But so it depends on the examples. I think we agree 100% on a lot of things, and I think we disagree on other things because we might be thinking of different scenarios that we see every day versus maybe you're just thinking of scenarios, or maybe he's an advisor. I don't know. I'm not here to sell books. We gave the books away.
And we'll send you one, Keith,
Gave
if
them
you
away
want.
for
Just let
free.
us know.
Keith, I want to give you a book.
He's not.
I love Keith.
He doesn't want it.
He doesn't. Let's give Keith a book.
Keith, give us your address. We'll send you a book for free.
I love the comments. I love the feedback. I mean, we can have discussions. Al and I disagree on almost nothing. So that's why. No, I'm kidding. We disagree quite a bit. He's a CPA. He runs the numbers. I'm like, you know what? I'm just going to convert. I don't ever want to think about taxes ever again. I like the compounding tax-free growth. Yeah, I might pay it a little bit more in tax. Maybe it wasn't as effective or efficient as possible. But guess what? When I look at my retirement account and it's $1 million and it's tax-free, it's all mine. It's all mine. All right, that's it. Thanks, Keith.